The system isn't breaking because of bad decisions. It's breaking because of good ones, decisions that made perfect sense at the time. And that's exactly what makes this so dangerous for anyone who thinks they're protected. Most people believe the financial system breaks from greed or corruption. It doesn't. It breaks from something far more predictable, something that's baked into how it was designed to work. And every time it breaks, the real cost isn't paid by the people who caused it. That's the part nobody wants you to understand yet. There's a pattern the banks noticed decades ago that they never discussed in public, a pattern about how crises actually start. And once you see it, you realize the next break isn't a question of if, it's a question of when, and whether you'll see it coming. I spent years watching this from inside the system, not managing money, not making trades, just observing how decisions got made when nobody was performing for cameras. And I can tell you this, the people running these institutions aren't reckless. They're trapped. They're operating a system that requires constant growth to survive, and that requirement is what guarantees it will eventually break again. Here's what nobody wants to admit publicly. The financial system doesn't stay stable because it's well managed. It stays stable because everyone agrees to pretend certain things are true, that assets are worth what the market says they're worth, that debt will be repaid, that growth will continue indefinitely. That's the game. Collective belief holding back collective panic. And the moment that belief cracks, everything moves at once. The system breaks the same way every time, not because people are stupid, because the incentives are designed to push everyone toward the same cliff edge together. When times are good, taking risks looks smart. Conservative players get left behind, so everyone takes on more leverage, more debt, more exposure, and they all convince themselves this time is different, that they've learned from the past, that the warning signs don't apply to them. But the warning signs are always the same. In 2008, it was mortgage-backed securities. Everyone knew housing prices had gone up too fast, but everyone also believed they could sell before the crash. They were all watching the same indicators, all running the same risk models, all making the same bet. And when it broke everywhere at once, because they were all connected in ways nobody had fully mapped. The bailouts came. Trillions of dollars, and everyone said it was temporary, that the system would be reformed, that this would never happen again. But here's what actually happened. The system got bigger, more concentrated, more interconnected, because the institutions that survived didn't just recover, they absorbed the ones that failed. They became too big to fail squared. Now, here's where it gets more dangerous than 2008. The tools they used to fix the last crisis became the foundation of the next one. They lowered interest rates to zero. They printed money on a scale never attempted in history. They turned central banks into the biggest buyers of government debt. And for over a decade, it worked. Markets went up, confidence returned, everyone relaxed. But those emergency measures never ended. They became permanent, and now we're in a situation where the system can't function without them, can't survive without cheap money, can't grow without continued intervention. The moment they try to normalize, something breaks. A bank collapses, a market freezes, a country defaults. Look at what happened in 2023. Silicon Valley Bank failed not because of fraud, not because of corruption, because interest rates went up and suddenly their perfectly safe government bonds were worth less than they paid for them. A problem so basic it's taught in first-year finance courses. And yet it brought down a major bank anyway because the entire system had adapted to free money. And when that changed, everyone who had made decisions based on that reality was suddenly exposed. The response was immediate. The Federal Reserve stepped in, guaranteed all deposits, created new lending facilities, basically another bailout with a different name. And it worked. For now.
because belief was restored, but the underlying problem wasn't fixed, it was postponed. And that's what makes this different from every previous crisis. There's no room left for error. Interest rates can't be lowered much further. Central banks already own massive portions of the bond market. Government debt is at levels previously only seen during world wars. The ammunition that was used to fight the last crisis has already been spent, and everyone inside the system knows it. That's why you're seeing such extreme reactions to small problems now, why a regional bank failure creates panic, why inflation suddenly became the thing everyone fears, because the system has no margin for error left, no backup plan that hasn't already been deployed. Now, here's the part that should concern anyone with money in this system. The next break won't look like 2008. It won't start with housing or banks. It'll start with something that seems unrelated. Maybe it's government debt. Maybe it's corporate bonds. Maybe it's a currency crisis in a country everyone thought was stable. The specific trigger doesn't matter as much as the fact that everything is connected, and when one thing breaks under this much pressure, the force gets transferred everywhere else.
And it's already closer than most people think. If you want to understand money before it moves, not after, subscribe to Dropout Finance. Because the people who see the breaks coming aren't the ones making predictions, they're the ones who stopped believing in permanence.